So we have here IFRS 13, fair value measurement. Fair value measurement. IFRS 13, fair value measurement. Fair value measurement. So, ladies and gentlemen, if you have assets, you have liabilities, it will be very important for you to attach a value. Remember, we are still doing topic number 1. If you look at your course outline, topic number 1, you'll be able to see we still have many standards here to cover. All right. So IFRS 13, fair value measurement. Fair value measurement. So whenever you have a new, not a new, but just any asset, even if it's a jalopy, an old motor vehicle, what will be the very best way of measuring its value? All right. You can't just keep on, in this case here, like giving us what we call net book value. I bought this asset at $1 million Kenyan shillings. I've been depreciating it like this. No. It will be very important for you to ask yourself, is it possible for me to have a buyer for this asset? If I was to take this asset today to a market, willing buyer, willing seller, how much will I be able to realize out of this particular asset? So how much will I be able to sell this asset? That value is what we call a fair value, is what we call a market value. So if this vehicle, for example, the fair value is say 2 million or whatever, it is at 2 million that I will be able to take and have it represented or financially reported in my books. So the biggest problem which IFRS 13 is trying to answer here, how do we get them to ascertain this fair value, especially in situations where there are no market participants, where there are no even markets. You know, there are some assets, however much you would want to have their market value, there are some assets that are very unique. You can't get their market value. There is nobody who is willing to buy that kind of an asset. There's not even a single asset that is quite similar to it, which has been sold in the near past. So now how do you get to ascertain, ladies and gentlemen, the value of that kind of what here, an asset? So with me, I have these particular notes of ours that I would want us to read, here. So it is page number 16. Page number 16 of our SBR book. Very important book. This book will make you see places. IFRS 13, fair value measurement. And I will read through this very fast. It's a very short standard, and then I should be able to allow you guys to get to your normal things here. So the objective of IFRS 13 is to provide a single source of guidance. A single source of guidance for fair value measurement where it is required by a reporting standard rather than it being spread throughout several reporting standards. Many accounting standards require or allow items to be measured at fair value. Some examples from your prior studies here include, for example, IAS 16. So IAS 16, where we have property, plant, and equipment, it allows entities to measure property, plant, and equipment at market value, at fair value. IFRS 3, which is a consolidation standard, which we'll be discussing just in a few days, which is business combination, when businesses are combined. It requires the identifiable net assets of a subsidiary to be measured at fair value at the acquisition date. IFRS 13 does not apply to share-based payment transactions, what we were doing here yesterday. It does not also apply to leases, IFRS 16, the definition of fair value. Fair value is defined as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13, paragraph 9. The price that would be received to sell an asset, actually that's what I would stick with. But if I sell this asset of mine, ladies and gentlemen, this is the price that I'll be able to receive. All right. Or pay to transfer a liability in an orderly transaction between market participants at the measurement date. So there is no coercion here, really. So we are two parties here, two participants here at some marketplace. This person has brought a computer. So this computer, what price do we agree to have this computer exchange between ourselves? Give me 10,000. Giving you like, so we agree on a price. That price that we shall agree between ourselves, ladies and gentlemen, is what we are calling a fair price. Market participants are knowledgeable third parties. Uwezi ukasema sasa unaenda kuuzia mtoto mdogo useme hii ndio all of us are knowledgeable. So if it's about goat business, all of us have done this kind of business before. So we are knowledgeable third parties here. When pricing an asset or a liability, they would take into account the condition, locations, restrictions on use. Restrictions on use. All right. So for example, you'll get so many people, so many places like where I stay, where we have a restricted development. I mean, you are told that you can't build a house, which is, for example, of a different, I mean, most of the houses are very, very similar. All right. At times when you restrict your land like that, that land really, even if it's very close to, let's say, superhighway, thicker superhighway, next to superhighway there, you will not be able to get really very good price if you are to sell it. Why? Because now, right now, people have that affinity of, doing very big high-rise apartments. So if then you can't, if you are restricting them, of course, those guys will tell you that we want to live in a place that is quite restricted. But for sure, most people would want a place where they can do business, you know. It should be assumed that the market participants are not forced into transactions. They are not suffering from cash flow shortages, for example. It's not a forced sale. It's not a forced sale. So this is between knowledgeable participants, and of course, they are doing this willingly. IFRS 13 notes that there are various approaches to determining the fair value of an asset to liability. So we have the market approaches. So market approaches, valuations based on recent sales prices. All right. So I want to sell, in this case here, my Toyota Fielder. I'll ask myself, is there any Fielder that has been sold? If I go to the market, I'll be able to know, like Fielders that were sold last week, how much were they fetching? If they're fetching $1 million, then I'm so sure I'll be able to sell my Fielder at that amount. So any Fielder that I have at the moment, then in the books of the business, I should be able to maintain that Fielder at this particular market value. Then we have cost approaches. If, for example, there is no market for this type of Fielder, maybe it's a high, not a high level, but I mean, how do you call this? I mean, it has got many CCs, all right? So in this case, it's not a business vehicle, all right? So in that case, then I can look at what we call the cost model, the cost model. So if it's a house, I'm doing like bills of quantities, all right? Be able to know in this case here how much it will cost me. So cost approaches, you are not going to the market. You're basically asking yourself, how much, in this case here, did this particular house cost me to build? Income approaches is what I teach you guys in advanced financial management, where you project incomes. Once you project incomes, you are able to discount them. You say, if it is an apartment that I'm getting 300,000 every month, so per year it is this much, 30 years down the line, then those cash flows, I discount them. Income up. So we have got 3 approaches to determining the fair value. You could either make use of market approach, or you do costing, or you look at the incomes and then you discount them. So valuation based on what we call financial, for whatever approach is taken, the aim is always the same, to estimate the price that will be transferred in a transaction with a market participant. The price. Fair value is a market-based measurement, not one that is entity specific. So fair value is a market-based measurement, not one that is entity specific. As such, when determining the price at which an asset would be sold, or the price paid to transfer a liability, observable data from active markets should be used where possible. Ladies and gentlemen, if you have some data that you can observe associated to some similar or identical kind of assets which have been sold at that price, then that price is the one that we shall use, active markets. An active market is a market where transactions for the asset or liability occur frequently. Like if, for example, you'd want to sell goats, I mean, you can go to, for example, the Kajiado markets. Those are active markets where goats are being sold every day. You can easily get prices there. IFRS 13 classifies, this is very popular in your exams. This one is very popular in your exams. IFRS 13 classifies inputs into valuation techniques, into three levels. The inputs that we shall use to be able to say, ladies and gentlemen, that this goat of mine is valued at this much. The three levels here. We have level 1 inputs. Inputs are quoted prices for identical assets in active markets. I have this goat. I have this particular sheep here. It's a topper sheep. I know the size. I can see the size. I can see this one. This one is very, very identical to mine. So if it's identical to mine and it was sold at 13,000, so now I'll be able to value mine at 13,000. So level 1 inputs are basically for identical items in the market. Identical items in the market. I'm selling Safaricom shares, and there are people who sold their Safaricom shares, for example, this morning. These are identical assets, you know. These are identical securities, you know. Then I should be able to value my assets here, I mean, at the same price that the transactions in the morning took place at. So level 1 is always for the thing here, you underscore identical assets. That's level 1. And then level 2, ladies and gentlemen, is for what here? For similar assets. Level 2 is for similar, not exactly the same, but this is quite similar to my house. You could have a house that was sold last week, which in this case here is quite close, resembling mine very, very closely, but not identical. Perhaps the difference would be this person has got for example, is a 3-bedroom, right? 3-bedroom, mine is 3-bedroom. Maybe this one here has got some kitchen, store, pantry area, etc. So quite similar, quite similar. So when it's similar, then it will be very easy for me to say, I mean, your house went for 13 million. Mine is close to your house, but it lacks this, so I can make adjustments, you know. So level 2, ladies and gentlemen, is when we have assets that are very, very similar. Leave alone most things here. Level 2 inputs are observable prices that are not level 1 inputs. They may include quoted prices for similar assets in active. Actually, just leave it like that. Level 2 is for similar assets here. And then now level 3, you can imagine if, for example, today you wanted to sell, which church is this? I normally confuse that church. The one that is near City Hall. There's a church near City Hall. Is it cathedral, or there is a church there that is quite unique? I mean, even if you go to any place in East Africa, you can't get a church that is very close, similar to that. Price of what here? Unique assets. Very unique assets, ladies and gentlemen. Very unique assets. Now to value them, you shall use what we call level 3. Level 3. Or it's a Holy Family Basilica. How would I confuse Holy Family Basilica? It's a Holy Family Basilica. So if you have ever been there, ladies and gentlemen, that church is very, very distinct. For those guys who travel quite a lot, I don't know whether there is anybody who has ever seen a church that has got the same type of what here buildings like that. So then if you are told here as a valuer, now you're coming in as a management accountant to help value Holy Family Basilica. You can't tell me that there was even churches, and who sells churches nowadays? I mean, you can't tell me that there is a church that has been sold, which is closely resembling, in this case here, the Family Basilica. No. So this is quite a unique asset. So if it's a unique asset, then you have to use what we call level 3 inputs. So here inputs are what here unobservable. I mean, there is nothing really that is quite identical or similar to these Holy Family Basilica that you can use. So the inputs here are unobservable. The level 3 inputs are unobservable. This could include, this could include cash or profit forecast using an entity's own data. Ladies and gentlemen, please listen and listen to me very well. Listen and listen to me very well. If I were you, and I would take like just very sketchy notes there, So you're saying in terms of a fair valuation, we have level 1. Level 1 is for the Siamese twins, identical in all respects, identical. It happens. It's possible to have an asset that is really, I mean, not even really, but the same as an asset that you're selling in the market. If the asset that you're selling in the market is similar to one that has, not similar, but identical to one that has been sold, say, yesterday or near, all right, in the near past, then automatically I'll be able to quote that item of mine at the same price like that. That's level 1. And then now we have level 2. Level 2 in this case, is not about identity. Level 2, ladies and gentlemen, is just about similarity, similar assets like that. And then now we have level 3. Level 3, not identical, not similar. In this case here, distinct items. So you've got no data to observe. So in this case here for level 3, we normally use discounted cash flows to value this. Use discounted cash flows to value this. So if it's Holy Family Basilica, because you've got nothing to compare to this particular church to be able to value it, then what do? Use discounted cash flow. So it's very easy as an accountant. Take in this case like 5 years history, talk to the priests over there. How much do you normally get in terms of offerings and donations and tithes, whatever, every week? Take that to monthly, take that to yearly. So in this case, you're able to get like, this is the contribution that comes to this church every year. Get the risk-free rate, risk-free rate. In this case here from the Central Bank of Kenya. Use those cash flows, for example, like now predict them. You know, you have been able to use the history, now predict them in the future, and then now discount them into the present, and then tell these people that, you know what, Holy Family Basilica is worth this much. So level 3 is quite what is haphazard here. I mean, you've got nothing really on the table to compare. So what you do, you basically use what we call the discounted cash flow method to discount the cash flows to get the present value. Now from there, ladies and gentlemen, if you allow Mwalimu here, you can see a priority is given to level 1 inputs. The lowest priority is given to level 3 what here inputs here. I mean, assets where you have level 3 inputs that are unobservable, nothing similar. Those assets normally are not easy to sell, like these antiques. Like you must have seen guys who are into these very old vehicles. All right, those old vehicles will not be very easy for you to get markets for the same, and yet they are very pricey outside here. So in this case here, those ones you'll have to look at. I mean, how do you generate your what is your business model? How are you getting your cash flows? So predict the cash flows, and then you do what here? You straight away get to this. Has been asked severally, and you're going to see from your past papers severally. These have been asked, ladies and gentlemen. From there, then I'll be able to go to, like this is very important, 𝒂𝒊𝒆. You can go and look at the answer later. 𝒂𝒊𝒆 has an investment property that is measured at fair value. This property is rented out on short-term leases. The directors wish to fair value the property by estimating the present value of the net cash flows that the property will generate for 𝒂𝒊𝒆. They argue that this best reflects the way in which the building will generate economic benefits. The building is very unique. Although there have been many sales of similar buildings in the local area. So discuss whether the evaluation technique suggested by the directors complies with international financial reporting. That's a lie. Ladies and gentlemen, we can be told here that, or rather we are told here that, you know, like what they're trying to use here, valuing their property using net cash flows discounted technique. This is level 3. And level 3 is only applicable for very unique buildings. Buildings in this case that have got nothing similar to compare to. But if you look at this very well here, the building is unique, although there have been many sales of similar buildings in the local area. So these guys here should have fetched level 2 inputs, similarity. You know, this one in paragraph 2, ladies and gentlemen, is level 3, where basically you've got nothing similar to this. A very unique, yes, a very unique asset where we've got nothing close by to it that has been sold in the near past. So in terms of IFRS reporting, these guys are pretty wrong. They should have used, in this case here, level 2, and you can come and see the answer here. You can see the answer. Nope. Baklava. So baklava, I think baklava is 3. Yes. So baklava is here. The director's estimate of the future net cash flows that the building will generate is a level 3 input. IFRS 13 gives lowest priority to level 3 inputs. This should not be used if level 1 or level 2 inputs exist. Observable data about the recent sales price of similar properties is a level 2 input. The fair value of the building should therefore be based on these prices, with adjustments made as necessary to reflect the specific location and condition of baklava's building. Ladies and gentlemen, from there, we go straight away to markets. Very, very common. If you did last semester's exam, they gave us a question from this area. Markets. The price received when an asset is sold or paid when a liability is extinguished may differ depending on the specific market where the transaction occurs. We have got 2 types of markets. We have the principal market, and then we have the most advantageous market. Principal market and the most advantageous market. So IFRS 13 says that the fair value should be measured by reference to the principal market. Reference to the principal market. The principal market is the market with the greatest activity for the asset or liability being measured here. Like our principal market in terms of securities in Kenya here will be the Nairobi Stock Exchange. Greatest activity. The entity must be able to access the principal market at the measurement date. So at the measurement date, you must go to the Nairobi Stock Exchange, use the accountant, that they get to see this 31st December, how are my shares trading? This means that the principal market for the same asset can differ between what year? Between entities here. So when do you want to measure this? The prices will be different between the dates, of course. And then now we have the most advantageous market, where you're going to get, in this case, the biggest benefit, where your net selling price will be highest. Where your net selling price will be highest. So most advantageous market, if there is no principal market, then fair value is measured by reference to prices in the most advantageous market. The most advantageous market is the one that maximizes the net selling amount. All right. And then now there is a disclaimer. Transaction costs such as legal and broker fees will play a role in deciding which market is most advantageous. They'll play a role. However, fair value is not adjusted for transaction cost because they are characteristic of the market rather than the asset. What you're supposed to know is that transaction costs fine, they will be able to help us when you are ascertaining most advantageous. But we shall always exclude it whenever you're getting the fair price. Whenever you're getting the fair price, transaction costs will always be excluded. For us to understand what we're talking about, we have this example. Test your understanding for market. So we have market 1, then we have market 2. An asset is sold in 2 different active markets at different prices. An entity enters into transactions in both markets and can access the price in those markets for the assets at the measurement date as follows. So we have here price in market 1 is 26, transaction cost is 3, and then we have the transport cost of 2. Then we have the net price receivable. So what is the fair value of the asset if market 1 is the principal market for the asset? Very easy. Fair value. The fair value. So if it's market 1 being used, how do we get this fair value? I will take, ladies and gentlemen, the price of this particular what year, the price of this particular asset, which is 26. And then you subtract other costs other than what your transaction cost. Transaction costs are what year very irrelevant whenever it comes to calculations of what year fair value according to IFRS 13. So then market one, ladies and gentlemen, if market one is our principal market, the only market we have at the moment, how do I get this fair value? Very easy. So to get this fair value, ladies and gentlemen, what I shall do to be able to get this fair value, ladies and gentlemen, this is what I shall do to be able to get this fair value. So fair value, I'll simply take the selling price minus, in this case here, transportation costs, minus transportation cost, minus transportation cost, minus transportation cost, minus transportation cost. Whenever it comes to fair valuation, just like how you have assumptions, in models, transaction cost will be taken to be 0. Transaction cost in this case here will be irrelevant in fair valuation exercise. So in this case here, remember they have told us it is market one that we are using here. It is market one that we are using. So our fair value will be equal to the selling price. So the selling price has been given to us. The selling price has been given to us as 26. So I will take 26 minus 2. 26 minus 2. So 26 minus 2, this is 24. So this 24 is the price at which you shall be able to carry your asset at in your books of accounts. In your books of accounts, not this net selling price, because here we want transaction cost. So, and please, you have your answers. You should be able to come and check your answers here, even if it's later. It's very important because I would want you to really use this book. Maximum there. Maximum there. So if market one is the principal market, then the fair value would be measured using the price that would be received in that market, less transport cost. The fair value would be 24, like that. Transaction costs are always ignored. Transaction costs are always ignored. So the fair value, so this asset, if you're taking it to the financial statements, you as an accountant, so this asset, you shall carry it at 24. This asset, you shall carry it at 24. Then look at the second question here. So the second question, they want us, ladies and gentlemen, in this case here to look at here. Now, no principal market can be determined. So if there is no principal market which can be determined, we shall always go to the second scenario where we ask ourselves, between the markets given, which is the most advantageous? Which is the most advantageous? Which is the most advantageous market? How do we get, in this case here, the most advantageous market? To get the most advantageous market, this is normally what we do. To get the most advantageous market, to get the most advantageous market, you compare between net selling prices. Net selling prices. So when you are looking at the net selling prices, basically you are not going to disregard any cost, not even transaction cost. So you look at the net selling prices and then you select the higher. You select the higher or the highest. So the market with the highest NSP, net selling price, then automatically will be your most advantageous market, your most advantageous market. So we have principal market and we have most advantageous market. So the most advantageous market, like in our case here, the most advantageous market, like in our case, ladies and gentlemen, here, if you look at this, look at the net selling price, 21, 22. So the market 2 is the most advantageous market because 22 is higher. So 22 is higher. So market 2 is the most advantageous, market here. And therefore, if number 2 is what we are looking at, and therefore the fair value, when it comes to fair valuation, ladies and gentlemen, I will always ignore now. Remember, when I'm getting most advantageous market, I have to compare and consider all costs because I'm looking at the net selling price. But now we have come to the ultimate. We've come in this case here to the bullseye, which is fair valuation. So to get this fair value, I will take the selling price given here. As usual, I subtract, in this case here, transportation costs. I subtract transportation cost. So the selling price in this particular question in market 2, remember now we have identified market 2 as our most advantageous market. So it is 25 minus the transportation cost, which is what here? Transportation cost minus transportation cost, which is 2. So it is 25 minus 2. 25 minus 2 gives me 23. So the fair value there will be 23. And for you to be able to understand what I'm talking about, ladies and gentlemen, simply look at the answer. You'll be able to see the answer giving you even better. If neither market is the principal market for the asset, then the fair value would be measured in the most advantageous market. The most advantageous market is the market that maximizes the net amount received from the sale. So you can see the net amount received in market 2 is 22 is higher than the net amount received in market 1, which is 21. Market 2 is therefore the most advantageous market. This results in a fair value measurement of 23. Remember, fair value is this selling price 25 minus 2. IFRS 13 specifies the transaction cost. IFRS 13 specifies that transaction costs play a role when determining which market is most advantageous, but they are not factored into the fair value measurement itself. So remember, ladies and gentlemen, mine is basically a high level for you to understand what is expected of us in the standard. Otherwise, when we come in this case here to revise, we shall be able to look at a past paper question and we'll be able to see that these guys normally steal questions from ACCA. So unless there is a question, I would want in this case here to go straight away to the next concept here. All right. So ladies and gentlemen, here we are. All right. Okay, so I need to go back a bit. Yeah, one of the books I should have not gone to the answers. Markets, yes. Yes, then now we have non-financial assets. So for non-financial assets like property, plant, and equipment, how do we do fair valuations here? Very easy. What's a non-financial asset? The difference between financial and non-financial asset is covered in detail in chapter 12 here. Financial assets, the ones, ladies and gentlemen, where you will easily get your cash here, like receivables, investment in equity shares. These are financial assets here from the word, like you're financing receivables here. You're going to, if you're raising, for example, cash, if you're raising capital, you're going to sell equity shares here. Non-financial assets include property, plant, and equipment, intangible assets. The fair value of a non-financial asset. IFRS 13 says that the fair value of a non-financial asset should be based on its highest and the best use. Highest and the best use. The highest and the best use of an asset is a use that a market participant would adopt in order to maximize its value. The current use of a non-financial asset can be assumed to be the highest and the best use, unless evidence exists to the contrary. The highest and best use should take into account uses that are physically possible, legally permissible. Don't tell me that you can now start growing mogoka. Mogoka is legal still. For example, bank in this land, and therefore I'm going to value this thing even in trillions. Financially feasible. IFRS 13 says a use can be legally permissible even if it's not legally approved. For us to understand, ladies and gentlemen, so remember, legal approvals, you can always look for approvals, and especially if there are other people who have gotten approvals in that particular area, then even if it was a restricted area, then I can now say that if my neighbor got this approval, I also get this approval. So what is the best use? Should I sell this land or should I build on it? What is the best use? If I build on it, cash flows. I'm going to get cash flows from my rental property. So best use perhaps could be that, or selling the land. So what is the best use? Very, very important for us to appreciate this, ladies and gentlemen. We come here, test your understanding 5. Test your understanding 5, the last concept that you're doing here. Test your understanding 5, 5 quarters. 5 quarters has purchased 100% of the ordinary shares of 3 halves and is trying to determine the fair value of the net assets at the acquisition date. 3 halves owns land that is currently developed for industrial use. The fair value of the land, if used in a manufacturing operation, is 5 million. So one of the ways is to develop this and put up a manufacturing plant. And if you do that, then you'll be able to get 5 million. So one of the ways of using this land to generate cash flows is to do manufacturing inside there. If we do manufacturing in there, we shall be able to get 5 million. So basically, currently, that's another way of telling you that currently this land is valued at 5 million. Many nearby plots of land have been developed for residential use as high-rise apartment buildings. The land owned by 3 halves does not have planning permission for residential use, although permission has been granted for similar plots of land. The fair value of 3 halves land as a vacant site for residential development is 6 million. The fair value of 3 halves land as a vacant site for residential development is 6 million. However, transformation cost is 0.3 million. Would need to be incurred to get the land into this condition. So, ladies and gentlemen, then should we consider in this case here getting into this residential development? What do you think shall we be able to earn? What do you think shall we be able to earn? What do you think shall we be able to earn? What do you think shall we be able to earn? Okay, Richard, I've seen your question. Should we consider in this case here developing this into residential? You can see in this case here we shall be able to get 6 million there. But remember, there is a transformation cost of 0.3. There is a transformation cost of 0.3. So the net benefit there will be 6 minus 0.3, which is 5.7. So then in this case here, you have to look at what is the best usage for this land. Should we put up a manufacturing operation there and get 5 million, or should we put up a residential property and get 5.7? So putting up a residential property getting 5.7 is higher. So the best use here is 5.7. Then in this case here, I would rather develop this particular residential and get 5.7. So it means the higher of the two, the best use. So it means that this land should be valued at 5.7. 5.7, not this 5 here. Because I mean, we are wise people. We shall always go for the best for this land. Where are we going to fetch the very best? Put up manufacturing and 5 million. Put up a residential and 5.7. I would rather earn 5.7. I would rather earn I hope now it's fine. I hope now it's fine. Thanks for that. Thanks for that. So I was just reading this test to understanding 5 quarters. I hope when we read the question, you guys were still hearing me. So I'd want to just go straight away to test your understanding. 5, read the answer now. Read the answer now. Yes, okay. So the answer is here. So land is a non-financial asset. IFRS 13 says that the fair value of a non-financial asset should be based on its highest and best use. This is presumed to be its current use. Unless evidence exists to the contrary, the current use of the asset would suggest a fair value of 5 million. However, there is evidence that market participants would be interested in developing the land for residential use. Residential use of the land is not legally prohibited. Similar plots of land have been granted planning permission. So it is likely that this particular plot of land will also be granted planning permission. If used for residential purposes, the fair value of land would be 5.7, which is 6 minus 0.3. So it would then seem that the land highest and best use is for residential development. So its fair value is therefore 5.7 is 5.7. So Richard wanted me to talk about this, that it says that IFRS 13 says a use can be legally permissible even if it's not legally approved. You know, like how you get approvals from City Hall to build a house here, right? That approval may not be given, but constructive. It's called substance over form. Your neighbors have already gotten that kind of permission in the past. So you should also be allowed in this case to make an assumption that should I seek for this approval, I'll be able to get it. I'll be able to get it. I may not have gotten it because you see, normally when we are doing fair valuation, we don't want to sell our assets. No, we don't want to sell our assets. Remember, we simply are looking for a way of saying that let's attach this value to this asset in our book. So you don't want to start looking for permissions from the city hall. It's going to cost us money. But we can now make assumptions that even if this is not really approved as of yet now, we shall be able to get that particular that particular approval when we seek it. Great. Thank you so much. Now, ladies and gentlemen, I would want us to just reflect about this topic. Today I happen to be having a very early morning meeting at the office. It normally doesn't happen because easily because I work fully from home, but there are days when we are required to be in the office just for the meeting, and then I come back. So then if, for example, today you go to your workplace as an accountant, and I want you to be practicing things that we teach you here, and then they tell you, today we want to do some fair valuation because there is an IFRS 13 that needs us to do fair valuation. What are your key take-homes from this standard? Your key take-homes that you'll never forget. Let me see. Everybody should be able to tell me what they have learned from this topic. Don't underrate this topic. This is a topic that has been tested quite heavily. It's a theoretical topic mostly, apart from the few mathematics that we have seen there. IFRS 13. What is your key take-home? Key take-home. I'm able to see very many take-homes. So level 1, identical asset, match salutations in Jogu. That is very good. Level 1, inputs are for identical assets. That's very, very important. That's a key take-home. Mary Ann is talking about markets here. I wish Mary Ann would have expounded that a bit. Distinct items. Yeah, for level 3. For level 3, distinct or unique assets, and then we shall always value them using the discounted cash flow technique. Discounted cash flow technique. I like what 𝒂𝒊𝒆 is telling me there. Level 2, similarity. Items that are what here? Similar. I like Jenny there. Level 1, identical. Level 2, similar. Yeah, At least Josephat is going home with something very important, advantageous market. And how do we get this advantageous market? The net selling price, net selling price. But if you get the highest net selling price, to get fair value, you must be very, very careful. Selling price minus transportation cost. Never include the transaction. Level 3, 𝒂𝒊𝒂𝒂𝒂𝒂, distinct cash flow. Lorraine. In this case here, principal markets, the most active market. Principal market, the most active market. Principal market, the most active market. The most active market. Fair value measurement is market-based measurement. I love that simple English, good English. Good English there. Market-based. A value between market participants, and they have to be third parties. Don't bring a brother and a brother here, and then you tell me that, Mwalimu, let us have this. If a brother is sold to a brother, that's not third parties, you know. Those guys here will be able to say, this was my younger brother. I used to beat him a little bit when he was young, so I'm selling this vehicle to him at almost a throwaway price. We need third parties here. Are you sure, Richard, that transportation cost is unnecessary? Is it transportation cost which is unnecessary to get fair value, or transaction cost? That's a good one. But always remember, it is transaction cost that you will not subtract, but you shall subtract transportation cost. You shall subtract transportation cost. So fair value of assets does not include, thank you very much. Now, Doreen, you have been able to summarize this. Does not include transaction cost. So market approaches, cost approaches, and income approaches to determine fair value. Great. Now, ladies and gentlemen, where we have reached, you must have realized that now we have covered all the IFRSs needed in topic number 1. All right. Although when I come to my tomorrow's class, I'll still be able to do, you know, there are other IFRSs, like now we have what we call rated parties. It's another topic. It's in topic number 4, rated parties. We have another one, for example, IFRS 8 segment reporting is in topic number 4, but I like covering all the IFRSs. So tomorrow I'll be looking at IFRS 8 segment reporting. Now, there is one thing I would want you guys now to start doing. All right. You see, a question from topic number 1, we should be able to answer it very well. So I would want, in this case here, to start getting champions. And these champions are those students who will be able to do some questions from the past paper. It doesn't matter whether they are right or wrong. Just one question, like every day, we must get a champion. Every day. And we're going to have this champion. It's going to be a ball that revolves between ourselves. So in this case here, I'll appoint the first champion. So the first champion, in the course of today, I would expect him or her to go to a past paper, touching on any of these IFRSs that you have done. You do one question, even if it's wrong, post it there. And then we should be able to mark that question for that student. Of course, that means we have to do it. So once in this case, you're a champion for today, now the next day, you'll be the one to appoint the champion. We need to do as many questions as possible. We try them in an exam environment where you're not looking at any solution. If I got this kind of a question on an exam, what would have I done in terms of this IFRS? Very, very important for us to be thorough. So my champion for today, we should be able to do research, go to your past papers, pick one question that you have not done. You can pick one from this IFRS 13. You know, the champion I specify for you. So IFRS 13, pick one question on IFRS 13, do it. Hata kama madhogodhanyo, andika tu. Okay, andika no label vizuri the question, throw it to our WhatsApp group. And this champion for today is none other than 𝒂𝒊𝒂𝒂𝒂𝒂. So 𝒂𝒊𝒂𝒂𝒂𝒂, I expect you to look around your past papers from last sitting. Look at any IFRS 13 question, do it and put it there, and then we shall be able to critique it. Otherwise, for today, I request that I disappear much early. It's good that I've seen you guys. I've got some takeaways from our session today. So thank you very much. Please put in your very best at your workplaces. Usichoke. Yuko mwana niambia mwalimu nasikia kuchoka acha nilale leo siendika. No. Always we shall appear in our workplaces and we shall do our very best. You don't know how. God will come and visit us, of course. Thank you so much. Bye. Great years. Discontinued operations of